Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you are concerned about higher than usual unrealized capital gains in your investment portfolio, stay tuned. What's our topic today? The three questions cross-border investors should ask about tax-efficient investment strategies. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Joining me once again on the Three Questions podcast is Steve Calley. He is the Chief Investment Officer here at One Capital Management, and he's also the Chairman of One Capital Management's Investment Committee. Steve is a chartered financial analyst, and he's a member of the Los Angeles Society of Financial Analysts. Today, we're going to be exploring the three questions cross-border investors should ask about tax-efficient investment strategies. And Steve, I know you've been a busy day. I'm literally pulling you out of the meetings here to get us on the podcast, get you on the podcast. So thanks for squeezing me into your busy schedule today.
It's as we always say, Wayne, it's a pleasure. Love talking to you. Love spending time with you. On the podcast and just in my office.
You're sitting. Yes, exactly. Our 5-minute meetings that turn into 45-minute meetings.
Exactly.
Okay, so Steve, you know what? I know we're kind of on a tight schedule today, but I want, before we get to the three questions, we got some catching up to do here. We had you back on the podcast in April, and at that time, all the buzz, as you remember, was about the Trump tariffs.
Yeah.
And I actually went back and listened to that episode. And the key message we got from that I took from the episode was patience will be required. So looking back now, how have those who were patient fared?
Much better than those that weren't. That's for sure.
Yeah.
Because those that, again, those that panicked or worried about the tariffs and what happened and were projecting what might happen, almost none of that has happened. The other thing we talked about is there's a lot that we're going into. There's a lot of legal challenges. It's interesting that that it's a great first thing to talk about, because I think I mentioned back then, and you'll have to remind me if I did or didn't, but there'll be legal challenges to that. Those legal challenges are really working through the courts. Trump and the administration has lost most of those in the lower courts. The Supreme Court in the United States has agreed to hear a lot of these issues, and it's our belief and our thinking that they're going to lose most of the tariff issues, and that I shouldn't say most of the tariff. It's using national defense and national emergency as a reason to do the tariffs. It was an act that was used during World War II. He kind of pulled it out of the archives, dusted it off, and he's going to lose that case. He's not going to lose all tariffs, but he's going to lose that argument for the tariffs. There's going to be some issues that come up. What happens with the tariffs that have already been paid? Do they have to refund them? It's going to be a little bit messy come here towards the end of the year and first part of next year. So patience is still required. How about that one?
Well, that stands on its own merit virtually at any point in time.
Yeah.
Now, this podcast reaches listeners across the United States, Canada, and likely, outside of North America, including, hopefully, a good number of my clients. And between now and the end of the year, I'm going to be meeting with many of my clients, and that all being the case, I'm sure they would like to hear from you in regards to what you as Chief Investment Officer have been up to since the start of this year. Now, I do know that this has been a very busy year for One Capital Management's Investment Committee, and also for the portfolio managers who have been assigned a rather long to-do list. So maybe it'll be a good idea right now for you just to give the folks listening in here an update on some of the changes to both our U.S. and Canadian portfolios. And I'll let you kind of take over from here and just give us an update. And I might chime in at some point here, but just take it away on what you've been up to for the last few months.
So it has been a very busy year, as you said, Wayne. And one of the things that we do, and part of the the reason for this podcast is tax efficient, and we do a lot of that. And we've had a few conversations, but this year there's been a lot of changes that have taken place in the portfolio. We've added certain assets to the portfolio. We've taken some investments out of the portfolio as we rework it, as we see the changing environment that's happening. Because, while I was a little bit dismissive of the tariffs in the sense that it's going to take patience, the reality is things are changing, dynamics are changing, how we do business is changing, and that is a reflection of the tariffs, and it's a reflection of policy. It's a reflection of the attitude of this administration. So things are changing, and we've been trying to address that and trying to get ahead of these things, looking at the investments that we have, looking at the individual companies we have, the ETFs that we have, where we have our assets placed, and we've done a lot this year to refocus and make sure that we're in, as we always do, as we look out 18 months to 2 years, are we in the right place? Have we set ourselves up for success in 2020, obviously 2025, but in 26 and 27 as well. So we're going to talk about tax efficient investing, but sometimes you can't let the tail wag the dog. So we're here to win, and sometimes that means you pay taxes. And this year, 2025, for One Capital Management, I don't talk for anybody outside of it, but for One Capital Management, our clients are going to have a little bit higher tax bills because of the changes that we've made. We've had very successful investments that we've kind of moved around, and so people are going to have a little bit higher tax bill this year. And believe me, you talk about our portfolio managers who work with us. We are so focused on tax efficient investing that I've had to literally intervene and say, guys, we're here to win. And sometimes that means we have to take taxes because they're so focused on making sure that we do, the most efficient manner of doing this and minimizing the taxes that we best we can. Sometimes we just have a year like this where there's a lot going on. We realize a lot of capital gains, and that means that you're winning. That means that we've done such a good job. There are no losses to offset these gains. We've already done it. You see, we've done a really, really good job over the years, all of the years I've been in this business, and especially here at One Capital Management. But this is going to be a year, just kind of a heads up caveat for your clients. It's going to be a little higher tax year because we've had to do some things. So, just along those lines, we did a 351 exchange where we were able to, in the US, not for the Canadians, we had to do a little bit different way, but we've exchanged some ETF holdings where we went from a passive growth in the small and mid cap space to an actively managed small and mid cap space. We did that because of the dynamics of the markets and the dynamics of passive investments and passive indexes. They tend to have a few more losers in it than we like. And by going active, we can weed out, we can factor out those things. So we've changed some investments there, which we were highly successful in our small and mid cap space. So we had capital gains there. In the US, we did what's called a 351 exchange. Think of it as like a 1031 exchange for real estate. We did that without a capital gain. In Canada, we couldn't do that. There was no advantage. There was no possibility to do that. So we had a little bit higher gains as we moved from a passive strategy, which has been very successful, to an active strategy that's been very successful. And the call you just pulled me out of, just since we've done that switch, we've outperformed that passive index by almost 3%. Just in the short while we've had it. So again, we're doing the right things for our clients. We're doing the thing. The other thing that we added is, we've added some private credit and private equity to the portfolios. We took microcap out of the space. We took a little small cap out. We took a little bit of international out, and we put that into private assets into the portfolios because, and we could have a whole podcast on that. But the private asset space is it's where the smaller and good sized companies are growing. In the US, 70% of companies that make 100 million or more in EBITDA are private. So in the public markets, if you're just going to the stock market, you're losing the opportunity for 70% of the companies that are out there that are very profitable. So we've added that to the space. We've taken out, we took out AT&T, we took out Target, we took out Johnson & Johnson, we took out Starbucks, Manulife, TD, we've added Merck, we've added DR Horton. So like I said, we're changing things, and we could go through all those names, and I because of time, I don't really want to go through all the names, but we're doing that because, again, the markets are changing. The focus and where we're going is, and I know you've had conversation about AI, and you and I personally have had plenty of conversations about it. But technology and AI is changing the dynamics of things, and so it's changing how companies are addressing some things. Tariffs affect companies like Johnson and Johnson and Target and some of those things. Starbucks is they've kind of hit a dry spell where they don't have the growth, and they've made a huge commitment to China. It hasn't worked out really well. They've done a lot of cleanup that they need to do. So again, they've been successful investments for us, but we've exited them. We're going to let them mature. We're going to see how they, rework themselves. And if there's an opportunity, we'll go back to them. But we've just kind of positioned the portfolio for the rest of this year, but mostly for 2026, 2027, and the dynamics that are taking place around the globe.
And we're positioning to win, as you said. A good friend of mine once told me, he said, Wayne, there's never a wrong time to do the right thing.
Yeah.
And if he's listening in today, he's going to give me a little nod there. From your standpoint of any of these exits, what you mentioned, the some of the business companies you traded out, were any of those decisions difficult for you to make, or was it really just, it was it, were you ever second guessing yourself or wondering if this was the right move, or would it, in your mind, was it an absolute no brainer in each instance?
I'd say that emotion, like everybody tries to take emotion out of their investments, and you get a little bit emotionally attached to it. I mean, even the professionals like us. So the answer is every so often you get a twinge. Most of again, the ads, the changes from the small cap going passive act, no question whatsoever. But when you look at a company like a Starbucks, which has been so successful, you kind of second guess yourself a little bit. But again, we let the numbers dictate. We let the news, we let what's happening dictate to us, and we don't. We minimize that emotional attachment to them the best we possibly can. So sometimes there's a little twinge. Sometimes once these companies they struggle, the prices get really cheap, and you look at it and say, oh, but it's only trading at X multiple, which is cheaper than it's ever been before, and so that value side of you kind of comes in and say, well, wait a minute, this is so cheap, maybe I should hold it. But then you look at the fundamentals, you look at the dynamics, you look at all the work that they've got to do, and you say, why wait? Why sit on dead money when I can go to a better opportunity now? And if they fix themselves, if they correct the issues, then we can always come back and make that investment. So it is pretty easy to make those decisions. A lot of them are super easy. It's just you let the numbers dictate. And we've talked about this. You don't get caught up in the media. You don't get caught up in the hype. You don't get caught up in all that emotion. You look at the data. You look at the numbers, you look at what's happening, and you make the decision based on hard facts, not emotions. And so most of it's really easy to do.
One thing I learned in the investment world, when it comes to owning investments, you're dating, you're not getting married, right, Steve? That's basically the good analogy.
That's a great one.
Okay, so it's time to address our 3 questions cross-border investors should ask about tax-efficient investment strategies. Again, our guest is Steve Kelly. He's the Chief Investment Officer here at One Capital Management. Okay, Steve, let's go. Question number 1. Can you explain why I should realize a loss on a stock that I believe has lots of upside? Steve, take it away.
That's maybe the easiest of your 3 questions you're going to ask me today, right? And the real reason is because
easing in here, Steve.
Thank you, Wayne. That if you have an unrealized loss in your portfolio, there's no value to it. And what I mean, there's no value to it, you're just looking at a negative on your statement, you've lost some money. If you realize that loss and you put that loss and you realize it, so you've sold the thing, you've got a loss in your, that actually becomes an asset. So it becomes valuable to you. An unrealized loss has no value. A realized loss has value. And the value is it offsets capital gains later on down the road. So that's a really easy one. And here at One Capital Management, it's one of the things that we look for. We look for opportunities. You're never right on your timing 100% of the time. So sometimes you've got a great idea, you've got a great company, and it just pays to you want to buy it because again, you don't want you've made the analysis. It's a great company. You want to own it, and so you buy it. But it doesn't work out always. So there may be some additional news that goes down. One of the names that we added to the portfolio last year is a company ASML, which makes the equipment that makes the semiconductors. And we bought it. It was down. There was some negative news. There was some sales slowing that took place. We looked at the company again, looking at the AI, looking at chip world, looking at everything that's happening. It was a no-brainer to buy that company because it's a great company with a great product that was going to be in significant demand in the future. But it was down 30-40%. Again, talk about the no-brainer buys. That was one of them. Well, immediately after that, the news didn't turn on a dime. We didn't get perfect news the next day, and the stock dropped another 15-20%. So now we're down, but it's a great company. We love it. So what we did is we did tax trading, and in the U.S. and Canada, it's a little bit different, just because of the rules. But in the United States, we could buy additional stock, wait 31 days to get past what's called a wash sale rule with the IRS, and then sell the original purchase stock, realize that loss. We kept the position the whole time. We just doubled it up for a little while. We sold it off, and we put that loss in our pocket. Now, since that, ASML is up about 70%. So had we just done nothing,
there's a lot of buzz right now. Even this morning, I was listening in on the financial
exactly.
TV news, and I think they probably spent about 10-15 minutes on ASML, just as an FYI.
Exactly. So here's it's a great example. Here's a great company. We love it. It's got a loss. Why would you sell it? Well, we're selling it because we want to put that loss in our pocket to offset a capital gain down the road. Because remember, we sold Target, we sold Johnson & Johnson, we sold these other companies. Let's use that loss to offset the gains that we had in those and minimize our taxes for the year.
Okay, before we go on to the second question, Steve, could you explain how cross-border investors like Canadians with U.S. holdings can use tax loss harvesting to offset gains? And I know
Yes,
there's lots of different strategies here. Maybe we can just give the 35,000-foot level
yeah.
on.
So in Canada, because in the U.S. we use what's called tax lot. So every lot that you buy is a standalone position. In Canada, it's average cost.
Average.
So if I buy two different lots, we average the price of them together. So I can't use the same strategy in Canada that I do in the United States. So there's a couple of things you can do in Canada. And one of the things that we do is we look at a company, and again, because we've got that 31-day window, and we can kind of see what's happening in the marketplace. So the first thing you could do is you could just sell it, wait 31 days, and buy back into it. I don't particularly care for that strategy because what happens is you're out of the market. So you might be wrong. So a lot of times what we'll do is we'll find a similar type of investment, usually
like a proxy.
Like a proxy. So typically it's going to be an ETF that owns, a chunk of that, or at least owns the same. So in the ASML case, what we'd do is we'd buy a real tech heavy ETF, so that if the technology were to run in those 30 days, we'd still participate in that. So in Canada, we have to massage it a little bit. We'll, sell it, buy a proxy for it, wait those 31 days, and then just flip them back. And then we're back in that ASML. So there's a couple of different ways you can do it in Canada, but that's using a proxy is usually what we do. Every so often, if we just don't have if we don't have the capital to do that, we might actually sell it, wait 31 days, paying close attention to it, and then go back into it after the month is over.
All right. So let's move on to question number 2. I have a position in my portfolio that has a $200,000 unrealized capital gain. My advisor is telling me that I need to trim some gains. Is this a good idea? Mr. Calley.
But this is the little bit tougher question, because there's a lot more to that than just the $200,000 and should I trim it or should I not?
Mm-hmm.
So the answer is going to be, it depends.
I knew it.
Yep. I could have gone with my yes and no.
I know 1,000 attorneys here in the United States who would answer the same way. It depends.
Exactly. So and we run into this all the time where we have a big position, and just kind of a side story. Early in my career, I was at a company. We had General Electric stock that was just massive holdings, and everybody had it, and nobody wanted to sell it. We ran into this very early situation where nobody wanted to sell it. GE, it was Jack Welch era, and everything was going great. And I would have to tell them, and it was big position in that portfolio. And it's like it just doesn't make sense for you to own this much of one stock. You're taking a single stock risk. You're adding to risk to your portfolio, not. I mean, diversification is about taking risk and mitigating it without giving up return. In this case, yeah, they're getting a good return, but they're actually significantly increasing the risk of that portfolio going back and forth. So when you have a situation like that, then the answer is yes, but let's do it in a tax efficient way as we possibly can. And there's a whole bunch of strategies around that. Again, just what we're talking about, tax loss harvesting. In my ASML case, I sold the SML. I put a couple $1,000s of loss in my pocket. Now I can go to this $200,000 position, realize some gains, offset the gain, and now I've trimmed it without having any tax issue. So that's why you would do these other tax loss harvesting when you have a loss in a company that you really like and that you want to continue to own, but you've harvested that tax loss and put it in your pocket for this very purpose to offset the gains of something like this. The other thing that you'd look at is how big is it? How concentrated is it? All of those things. That's why I say it depends. And so the answer is usually yes. It makes sense to trim that back, take some risk off the table. Now, there are some cases, and again, you do the fundamental analysis, and I'm going to use everybody's favorite just because it's the stock of the day. I was talking to somebody earlier, and the stock of the day back in 2000 was Cisco, but the stock of the day right now is NVIDIA. And back in 2000, I was trimming Cisco in some accounts that had these big, massive gains just like this. And I got more phone calls selling Cisco than I have on anything I've ever done. Today, roll 25 years forward, and NVIDIA is the one that everybody pays attention to. And so, it takes, you've got to take some stuff off the table. But at the same time, why I said it depends is because had we done that with NVIDIA early on, when we were getting our early gains in it, would have given up far too much. So the idea
is returns on that stock are absolutely ridiculous. So
exactly, and we were early into it. We were there before AI and all that. So, but the reason I say you've got to look at it, and it's got to be dynamic. You've got to look at all factors around that. So, for example, if if your stock is 200,000 and it's only 1% above what we would normally hold, you're splitting hairs. Now it's 2 or 3 times what you normally would hold in a pitch position like that. That's why I say usually when you have a big gain like this, it pays to trim it off to do something, and then do it as tax efficiently as you possibly can. And sometimes that means looking at a year like 2025 where we've already realized gains and pushing that sale off to January 2026. So you push the tax into next year. So there's a lot of things that you can do to make that efficient, but the simple answer is, yeah, you probably should trim some. Let's just do it the most efficient way possible.
I hope I'm not stepping on a line here, but I think we need to give a shout out to our friend Lance Meservy, because I think that NVIDIA was his baby, as I recall.
It was.
So, Lance, my buddy, way to go. Now it'll be a no-brainer, but this is back before when I remember asking friends of mine, have you ever heard of NVIDIA? And they're going, never heard of it. Why? Well, we got it in our... Okay, just quick, just I know we're running short here, but for One Capital client, Steve, I got to ask this before we move on to the next question. What role do market conditions like market volatility, I guess being the primary one? I mean, we could even bring in, if you want, the shutdown of the government, for example. These other conditions, what role do they play in deciding on trimming a gain, like a $200,000 gain? In general, how do we then reinvest afterwards? But like, how do these extenuating circumstances play into that decision-making process?
So that's a complex question. I could go for the next 30 minutes on that, which I'm not going to. We don't have the time. but the answer is that all of those things come into the decision-making process. As a matter of fact, I'm having this conversation a little bit earlier today. It's been one of those days where I'm on the phone and on these calls and making it all day long. But where you look at it and you say, has the fundamentals changed? And so could there be a market correction that's not fundamentally related? It's basically price related and it's emotion related. In that case, you're going to say, just let it go, like ride through that storm. It doesn't make any sense. So you're always looking at those market conditions. You're looking at that and you're saying, okay, is it fundamental, or is it just emotional, or is it just something that's a timing? And so all of that comes into play, and that's part of the process of when do you do something, how do you do it, and how much you take off the table in a situation like that. The other thing that you look at is you look at just the tax you'll pay. So I'm going to use your $200,000 example, and if this stock is, I'm going to just say it's 100% gain. So you've got, you bought $200,000, it's now worth 400,000, so it's 100% gain, and you're looking at trimming it because it's too big. Actually, let's make it Nvidia. So we paid $10,000 for it, and the stock's worth $200,000.
Yeah,
So
that's
now
a
you're
good
looking at
example.
something, and so it's almost all capital gain. So in that case, you'd say, okay, in the state of California, because that's where we're sitting right now, is you're going to pay a 20% capital gain at the federal level. You're going to pay a 3.85% Obamacare tax on that, and you're going to pay 13% state tax on that. So you add that up, and you're pretty close to a 45% or 35%, 36% tax on that. So if the stock drops more than 36%, you should sell it. But if the stock only drops 20 or 25%, you're still actually better off holding it than selling it and paying the tax on it. So all of those things come into account. So like I said, that's why I said we can spend a lot of time on that, because that's a big part of what we do, is evaluating all of those circumstances and saying, when do you do it? When does it make sense? And is this a fundamental change, or is it just just a temporary thing that's happening because people are nervous about, again, last weekend, we're going to put 100% tariff on China. China's going to retaliate. The markets fell off Thursday and Friday. And then on the
Recovered
weekend, they
on
went,
Monday and Tuesday.
yeah, because over the weekend, they said, well, we weren't really serious about that. It may happen. So again, those are the short-term things that are so hard to do, and you don't change because of those. If it
All
was
right.
a true fundamental, you make some changes for it.
Okay, I want to get to our third question because I just have this sense that the clock is running against us here, Steve. So, question number three. Our family trust has a legacy position that over the years has continued to appreciate. Of course, the downside is that my position now has a rather sizable unrealized capital gain. I have no intention of selling. Can you explain how I can tax efficiently work around this position and maintain some level of diversification? Mr. Callie, I'm going to give you a couple minutes on this one, the Cliff Notes version.
The Cliff Notes version are pretty tough, because this is where the situation gets very complex. This is where you look at multiple scenarios, multiple things that you can do. Now, again, it depends on, if you say I'm never going to sell it versus, hey, let's put a strategy in place to where we can trim this back over time. So I'm going to just throw out a scenario that we had. We had some clients up in the Northwest, and they bought a bunch of companies at the beginning, the Starbucks and the Costco's and the Microsoft. And so they had this exact scenario, huge legacy positions. And they're like, we just can't sell that because, our capital gain would have been a couple of $1 million. I mean, that's the tax on it, not the gain. The tax would have been a few $1 million. So then you work through the situation and say, okay, like, it makes sense to diversify this. Let's look at your personal, how much tax are you willing to take, how much pain, as you work this out. So you start to build a process of, how do we trim it down? Now, again, sometimes we don't, but if you're looking at it and saying, hey, it's just far too big, we've got to diversify this, we've got to do this. So there's a whole bunch of different methods. One of them is you just say, okay, let's just do this over multi-year. So I can live with, I'm just making up a number, I can live with $50,000 of tax a year. Okay, then typically what we'd do is we'd sell that early in the year. See, all that tax loss harvesting strategy that we do all year long, we're going to do that, minimize that. But if we've got a benchmark or a goal that we can hit at 50, I might be able to realize $100,000 worth of taxable gains, but only have to pay 50 because of all the other tax loss trading that I've done. So you'd work it that way. There are extreme situations where it's big, we're nervous about the market. We don't do this very often, but you could short the market, which means you sell something you actually don't own. If the market goes up, You use those gains to pay some of the taxes. If the market goes down, what happens is you sell it at a loss and you use that loss to offset that. That's a pretty extreme condition. We did have that in the case where somebody had such a large legacy and we just needed to diversify it. And so we took a little different methods. There's some other methods where you can do there's collar strategies around some options. Again, it's going to be very specific to the person. It's going to be very specific to the situation. There are things that you can do. The easiest is, well, not the easiest, but the best way is actually to win, which means you got to pay a little taxes sometime. But it's just, set that plan in motion, have a long-term goal and a long-term strategy, and realize that, as we said about tariffs at the beginning of this, sometimes it takes some patience. And, investing is for patient people, and working through situations sometimes takes patience as well. It takes a few years to get through some issues.
Well, I got some good news here. I had some other questions lined up for you, Steve, but you successfully answered them already. So we've actually pretty much covered everything I wanted. I guess just as we sort of wrap up the episode, again, I think it's important that you brought up this issue regarding the fact that, when we're in the tax loss harvesting business and you don't have any losses, you're kind of stuck. If we're the key thing that you said to me today, I think is, I hope the listeners here take very seriously, is that we're here to win. And there's never a wrong time to do the right thing. And sometimes, and this is back when I had the radio show in Toronto, former colleague of mine, Doug Riding. Hi, Doug. Doug helped me run my practice in Toronto. I know he's still up there rocking and rolling. And Doug used to come on the radio show with me once in a while, and we'd be talking about the same topic. And he would say, Wayne, my father used to tell me, you never get a loss when you realize a gain. So something to remember, but I want to thank you again for making time for us today. Great conversation, and more shall be revealed, my friend, and we'll be seeing you soon. Thanks a lot for joining us. I look forward to bringing you to the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.